What if two retired couples both spend about the same amount in a year, take a trip, help a grandchild, keep the lights on, enjoy dinner out now and then, and yet one couple owes federal income tax while the other legally owes zero? That sounds impossible the first time you hear it. But it is not magic, and it is not some hidden offshore trick. It usually comes down to one very simple idea. The tax bill does not look only at how much money you spent, it looks at what kind of money you used. And that is exactly why I make these videos. A lot of older people are doing their best, paying attention, trying not to make mistakes, and still getting hit with confusion because nobody ever sat down and explained this stuff in plain English. So if you want simple, calm help with money rules that can trip you up in retirement, go ahead and subscribe. Now, I know there are really two kinds of people watching this. One of you has been dealing with this for years. Maybe every spring you hand over your tax papers and hope for the best. Maybe you already know that pension money, IRA withdrawals, and investment income do not all get taxed the same way, but nobody has ever shown you how to make that work in your favor. The other person watching just got a surprise. Maybe you sold some stock, maybe you took money from an IRA, maybe your Social Security started looking more taxable than you expected. And now you are wondering, wait a minute, did I do this the hard way when I did not have to? Here's the hidden truth. Most people do not miss these tax-saving moves because they are careless. They miss them because they think like workers while they are living like retirees. When you are working, most of your money comes in one form. Wages, you do the job, the paycheck comes in, taxes come out, end of story. But many wealthy seniors do not live that way anymore. They may be rich on paper because they own assets, but their taxable income can still be surprisingly low. That is the part many people miss. Wealth and taxable income are not the same thing. So when someone says a rich retiree paid little or even zero federal income tax in a certain year, that does not automatically mean they cheated. It often means they knew which account to pull from, which income to delay, which gain could be taxed at a lower rate, and which move would accidentally raise the bill. My name is not important here as much as the job I do for you. I try to take financial rules that sound complicated and turn them into plain kitchen table English, so you can see what matters and ignore the noise. In this video, we are going to walk through what is really going on when seniors legally pay zero federal income tax. We will talk about what kind of money counts, why some withdrawals hit harder than others, how long-term gains can be treated very differently from regular income, and how one wrong move can wreck an otherwise low-tax year. If forms, account statements, IRA withdrawals, Social Security, or charity giving matter in your situation, I will show you where those fit in too. First, let's clear up the biggest misunderstanding of all. Spending money and creating taxable income are not the same thing. That one sentence is the whole ball game. Let's say you spend $70,000 this year. A lot of people hear that and assume the government sees $70,000 of income. Not necessarily. Suppose $28,000 came from Social Security. Suppose $20,000 came from cash you already had sitting in savings from years before. Suppose another $12,000 came from a qualified Roth IRA withdrawal. And suppose the last $10,000 came from selling an investment where only $3,000 of the sale was actual gain. You spent $70,000. But that does not mean you created $70,000 of taxable income. The money from savings is not new income just because you moved it from one pocket to another. In many cases, a qualified Roth IRA withdrawal is not taxable. Social Security may be partly taxable, fully non-taxable, or somewhere in between depending on your other income. And on that investment sale, the tax question is not the full sale price. It is the gain. This is where asset-rich retirees have an advantage. They often have choices. They may have some cash, some brokerage money, some retirement money, maybe some Roth money, maybe some bond interest, maybe some Social Security. And because the buckets are different, they can build a year that gives them the cash they need without automatically creating a big federal tax bill. That does not mean this works for everybody. If most of your income comes from a large pension and required IRA withdrawals, your picture may be very different. But if you have more than one bucket to draw from, this is where planning starts to matter. The action step here is simple. Pull out last year's tax return and make a one-page list of every place your money came from. Put each one into one of four groups, usually taxable, partly taxable, often tax-free, or not income at all. Do not guess. Just sort the buckets. Once you see the buckets, the whole picture starts to make sense. Now let's go one step deeper, because this is where the phrase pay zero taxes legally starts sounding more real. Some income is taxed at ordinary income rates. Some long-term gains are taxed at special rates. And under current rules, some long-term capital gains can fall into the 0% federal tax bracket if your taxable income is low enough. That last part matters more than most people realize. Let's use a simple example. Say a married retired couple owns stock they bought years ago for $15,000, and now it is worth $35,000. If they sell it, they have a $20,000 long-term gain. Not short-term, long-term, that matters. If their taxable income after deduction stays low enough, some or even all of that long-term gain may be taxed at 0% federally. Notice what I said there, taxable income after deductions. That is why richer seniors sometimes look poor on a tax return compared with how they actually live. They may have moderate taxable income, large savings, and appreciated investments. So instead of pulling every dollar from a traditional IRA and stacking up ordinary income, they may use a mix of money sources and harvest long-term gains while still staying in a favorable zone. And here's another important detail. The exact income cutoff for that 0% long-term gain rate changes over time, so do not use an old number you heard 3 years ago. Check the current year. But the principle stays the same. Long-term gains are not taxed the same way as wages, pensions, or ordinary IRA withdrawals. This also applies to a lot of qualified dividends, which often get the same favorable treatment as long-term capital gains. Now let me show you why this matters in ordinary life. Imagine Tom and Linda need $20,000 for a used car and some dental work. If they pull that $20,000 from a traditional IRA, that usually lands on the return as ordinary taxable income. If instead they sell a long-held investment with a $20,000 gain during a low-income year, the tax result could be much better. Same cash in hand, different tax result. That is not a loophole. That is simply the tax code treating different kinds of income differently. But there is one big warning here. If you owned the investment for 1 year or less, that is usually a short-term gain, and short-term gains are generally taxed like ordinary income. So the hold period matters. A lot. Your action step for this part is very specific. Before you sell appreciated stock, mutual funds, or other investments, ask one question first. How much of this sale is actual long-term gain, and what will it do to my taxable income this year? If you do not know that answer, do not sell first and ask later. And if this is already making more sense than the way taxes were explained to you before, stay with me, because the next part is where a lot of people accidentally turn a low tax year into a much more expensive one. Here is the mistake I see all the time. People assume an IRA withdrawal affects only the withdrawal itself, but that is often not what happens. A traditional IRA withdrawal can do more than add taxable income. It can also make more of your Social Security benefits taxable. That is the part that catches people off guard. And just to be clear, when people hear that up to 85% of Social Security can become taxable, that does not mean an 85% tax rate. It means up to 85% of the benefit can be counted as taxable income on your return, depending on your overall income. That is a very different thing, but it still matters. Let's say Harold receives $24,000 a year in Social Security. He thinks about taking $35,000 from his traditional IRA for a roof, a used pickup, and a few house repairs. In his mind, he is thinking, fine, I'll pay tax on the $35,000. But then tax time comes, and the return is bigger than he expected because that IRA withdrawal also pulled more of his Social Security into the taxable column. So the tax hit feels larger than the withdrawal amount alone would suggest. That is why retirees who want low tax years have to think in layers. It is not just, will this withdrawal be taxed? It is also, what else will this withdrawal affect? And then there is another issue, required minimum distributions. Under current rules, traditional IRA owners generally have to start taking required minimum distributions at age 73. Once those required withdrawals begin, your flexibility often gets smaller. You may want a zero tax year, but the account may force taxable income onto the return whether you need the cash or not. Roth IRAs are different. If you are the original owner, you do not have lifetime required minimum distributions from that Roth IRA. That is one reason Roth money can be so valuable in retirement. It can give you flexibility when traditional IRA money starts becoming less flexible. So a rich senior who legally pays little or no federal income tax in a given year often is not doing one flashy thing. They are avoiding one dumb thing. They are not pulling too much from the wrong account at the wrong time. This is a good place for a quick check-in. If you have ever taken money out of an IRA and then looked at the final tax bill like it had personally offended you, you are not alone. Retirement taxes have a way of smiling at you in June and biting you in March. The action step here is this. If you are already taking IRA withdrawals, or you are within a few years of 73, ask your tax preparer or financial planner for a simple projection before the year ends. Not a 40-page report, just a one-page estimate showing what happens if you take different withdrawal amounts. That one page can save you real money. Now let's get to the strongest example, because this one shows you how wealthy seniors stay generous, meet their goals, and sometimes keep more income off the return at the same time. A lot of people in retirement give money every year. Church, local shelter, food pantry, scholarship fund, hospital foundation, something they believe in. And many of them do it the expensive way without realizing it. Let's say Barbara and Ed are both over 70 and a half and they give $12,000 a year to charity. If they withdraw $12,000 from a traditional IRA, deposit it into their bank account, and then write checks to the charities, the IRA withdrawal still shows up as income. Yes, they may feel good about the giving, but from a tax point of view, they just raised their income first and donated second. For some people, there is a better way. If they are eligible and the money goes directly from the IRA custodian to a qualified charity, that can be a qualified charitable distribution. In plain English, the money can go straight from the IRA to the charity without being included in taxable income the way a normal withdrawal would be, and it can count toward a required minimum distribution. That is a huge distinction. The wealthy seniors who use this well are not chasing a gimmick. They are lining up their giving with the rules. They were already going to give the money. They just do it from the right place. And here is why that matters so much. Lower income on the return can help keep more of your Social Security from becoming taxable, can help keep you in a better range for other tax calculations, and can keep a low tax year from turning into a high tax year. This is one of the cleanest examples of what rich seniors really do. They do not just ask, how do I get a deduction? They ask, can I keep this amount from showing up as income in the first place? That is a much smarter question. And before you shrug this off and say, well, that is only for rich people, remember this. Rich in retirement often does not mean huge wages. It can simply mean you have assets, you have options, and you have enough control to choose which money moves first. Your action step here is very simple. If you are over 70 and a half and already giving to charity, call the company that holds your IRA and ask whether they handle direct charitable transfers from the account. Do that before you take the withdrawal yourself. Once the money hits your bank account, you may have lost the cleaner option. If this video is helping you think differently about retirement taxes, subscribe and keep coming back. I try to make these rules feel less like a tax seminar and more like a useful conversation with someone who actually wants you to keep more of your money. Now, before we wrap up, let me give you 2 bonus points for staying with me this long, because these are the kinds of details that can quietly matter. The first bonus point is a helpful one. Under current law, many people age 65 and older may qualify for an extra senior deduction on top of the usual standard deduction and the normal extra amount for being over 65. Right now, that added deduction is temporary and it phases out at higher income levels, so it does not apply to everybody. But for the people who do qualify, it can create even more room before ordinary federal income tax kicks in. That means a retiree near the edge of owing tax may be closer to a zero tax year than they realize. It also means one unnecessary withdrawal late in the year could cost more than expected if it pushes income high enough to lose part of that benefit. So if you are anywhere near the line, small decisions matter. The second bonus point is a warning. Do not let the phrase 0% capital gains trick you into sloppy selling. That favorable rate usually applies to long-term gains, not short-term gains. If you bought something 6 months ago and sell it now, the tax result can be completely different from selling something you have held for several years. Gain is not just gain. Time matters. And let me add one more quiet truth here. A lot of seniors who pay zero federal income tax in a given year are not doing anything dramatic. They are not trying to beat the system. They are simply making sure they do not create taxable income they did not need to create. That is the whole strategy. They know the difference between spending and income. They know the difference between ordinary income and long-term gain. They know that traditional IRA withdrawals can set off a chain reaction. They know that Roth money, cash savings, and direct charitable transfers can change the picture. And most of all, they know that the goal is not to brag about paying zero tax. The goal is to use the rules carefully, legally, and calmly so more of your retirement money stays available for your life instead of disappearing by mistake. So if I had to boil this whole video down to one message, it would be this. The seniors who pay little or no federal income tax are usually not the ones with the best secret. They are the ones who understand which dollars are taxable before they pull them. That is why this matters. One year-end decision can change how much of your Social Security becomes taxable, whether a gain is taxed at 0% or not, whether a charitable gift raises your income first, and whether you accidentally use the worst account for the job. And the one thing I would ask you to do today is this. Pull out last year's return, circle every source of money you used, and ask yourself one plain question about each one. Did this create taxable income, or did it just give me cash? If you do nothing else after this video, do that. One thing before you go. If you know one person who is retired, close to retired, or constantly worried that every withdrawal is going to trigger a tax surprise, send them this video. Not because it is flashy, not because it promises free money, just because it may help them ask a better question before they make the next move. And in the next video, I'm going to show you the retirement withdrawals that look harmless at first, but can quietly cost you more than expected by the end of the year. If you want to protect your income instead of guessing your way through it, I'll see you there.